Thank you, Amy, and good day, everybody. And at the outset, I'd really like to thank Amy for all of her work on these webinars. I mean, she really does incredible work along with her team. And so if you do want to chat and thank her, for by all means. Today is the last of last of the workshops on implementing GASB 87 leases. There were two other ones. We're taking advantage of today's technology to meet with a ton of you at one time. While there are limitations regarding webinars versus live training, we've made today's and the other lease workshops as interactive as possible. Hopefully at some point soon, we can certainly start doing things more live, but as of right now, we're going to be virtual, of course. Our first almost 4 hours talking about the basic provisions of GASB 87, lessee provisions and lessor provisions. Now, today we're talking about the rest of the story, and most of those are special cases, as I call them, in implementing GASB 87, but we're also going to introduce you to two additional standards that use the framework of GASB 87 and may cause additional contracts to be in scope of GASB 87, depending on those facts and circumstances. Now, joining this session today with me is James Ramsey, a partner in our Sacramento, California office. James works with governments throughout California, providing accounting, assurance, advisory services, and he's worked both on the client side and the assurance side, and is able to provide this unique perspective to his clients. He's a lot like I was. I started off in the public sector being a CFO and a state controller. And so he's kind of in a similar manner. Before going into public accounting, James began his career in the finance department of a small city government and performed most, if not all, of the functions of a finance department during his 7 years there. So he feels your pain. And this unique background and expertise allows James to provide more focused services to you in solutions. So welcome to the party, James. Today's session is going to be a quick overview in GASB 87. Hang on a second. There we go. Quick overview of GASB 87, where we've been. And we're going to try to make this as quick as possible, as I'm sure you've seen multiple presentations on the basics of GASB 87, including from me. But just in case, I'm going to spend the first few minutes reviewing it. As one of my former controllers used to say, 10 times for the normal mind, 100 times under stress. So this is only our third time through on this one, and clearly I have 97 more to go since we're all under stress. Then we're going to head down the road of all these special cases as I talk about. We're talking about subleases, sale-leasebacks, lease-leasebacks, intra-entity and related party leases. And I was just on a call about an hour ago with a client, and we were talking a little bit about leases between departments or contracts between departments, and that was a focus of our discussion. Then we're going to head down the road to two additional standards, GASB statement number 94, public-private and public-public partnerships and availability payment arrangements, also known as P3s. And on that one, that might cause you a few aha moments. And GASB statement number 96, subscription-based information technology arrangements, or SBITAs. And just to give you a hint on that last one, you're using at least one SBITA right at this second. Zoom is a SBITA, and perhaps Office 365, Windows Azure. Maybe you're watching us on your device, which would be Apple iOS or Android. That's a SBITA. And it really depends on your facts and circumstances. Let's just do a quick overview of some of the basics of Statement 87. If you're interested in the other workshops, and if you want to hear me and Lee Miller join me on the first one, you can get a replay on YouTube if you're really a glutton for punishment, and so certainly. Certainly, if you need the education, by all means, take a look. They're not for CPE credit, though. They're just for pure interest. As a reminder, the world of leasing is changing for every single organization, unless you're purely cash basis. But even so, you may be party to a lease and you really need to know who is leasing to you or who you're leasing from. All governments will be implementing at the same time. It includes tribal nations, airports, ports, marinas, utilities, entertainment venues, all are implementing this year and next. And there are certain aspects of the new standards that are easier than other aspects. But by and large, the lease standards released in Statement 87 that impact your government, the ones prior to that, the old stuff, has been around since the 1970s and with some aspects the 1940s. So those are long entrenched provisions that truly needed to be updated for current practice. Due to this lack of evolution, leases have been financially engineered to fit into the various exceptions. And this raises a huge problem. There are many operating leases that are really non-cancelable. And you may want to think about what we are facing. Take a look at your operating lease disclosure after the webinar in your financial report. And if you have operating leases listed in note disclosure until 2065, by my finger count, that's about 44 years from now. And I've seen plenty of clients and non-clients that have operating leases going out 15, 20, 30, 40 years. And you have to say to yourself, really? And that's why GASB 87 is here. Another challenge is the financial engineering built into many contracts. And in many cases, governments are limited from issuing any form of debt, and a lease is a debt of the lessee. After all, as a lessor, you sign a contract and the lessee has to fulfill the terms of the contract and live under the constraints. And one of those terms is that debt needs to be paid somehow, some way. And that is part of what we're facing as we all implement together. Now, we did have an extra year because of GASB 95 if you were a June 30 government, but that time has long gone by. We are at July 30th. We are well past time when we need to implement. And so you really need to get started right after this call. I'm having a conference call with another client getting started. The time to get going is now. And I cannot emphasize enough that GASB 87 is the gift that keeps on giving. You can't implement 87 and move on because each potential contract may have a leasing element that's built in. And so the internal controls needed to recognize a potential lease, those are key to success this year and every year into the future. As we'll talk about today, 2 additional standards are built off this exact same framework. And so we're going to be talking about this over and over again as you go on throughout the rest of your career. So under Statement 87, what is a lease? A lease is a contract that conveys control of the right to use a non-financial asset, which is also known as the underlying asset, for a period of time as specified in the contract in an exchange or an exchange-like transaction. Now, each of these phrases is precious, especially the word exchange and the phrase exchange-like. So for example, if a government leases land for $1 per year, but the value of that land, present value, is at $100,000 per year, well, that's not an even exchange. Or not even an exchange-like transaction, because the market rent is so much higher than what is in the contract. Now, similar agreements in your government then may not be in scope for implementation under GASB 87, and certainly in the implementations that I've been a part of so far, we see a bunch of those where it's $1 a year type of transaction. Now, there are exceptions from the lease provisions where we don't have to do any analysis. Some of these exceptions are on the screen. For example, contracts involving mining rights or oil rights, patents, software we're going to talk about in the next hour. Again, that's going to change after you implement GASB 87. And again, similar provisions, and that's GASB 96. plants and animals, livestock, zoo animals. Now, your government may have power purchase agreements, especially with solar panels on buildings, and you have to be careful on those. That it's not truly a purchase agreement for power, that it truly is a lease, and you have to analyze each one of those. Now, there are many questions on those power purchase agreements, and the question really comes down to the definition of control. And back in the first workshop, we had a participant ask about, for example, the temporary use of land for sporting purposes. And that question was directly related to a question in the first implementation guide issued, gosh, now almost 2 years ago. Now, in that question, a government has a 5-year agreement with another entity to use a piece of land for hunting and for a sporting club. Now, the club can only access the land during hunting season. Now, in that case, the access is a lease in accordance with GASB 87. But if the public can access the land in addition to the club, then it's not a lease because the club does not have exclusive access. And you can almost say the same thing about cellular hookups. Now, if more than one company can use the same hookup, then it's not exclusive access. So you need to be really careful on these types of contracts. The biggest change due to this definition is, again, no classification, no pretzel logic between operating and capital leases. You don't need to do any financial engineering just to fit around the accounting definitions from way in the past, back in the 1970s or 1940s and 50s. You don't need to do that anymore. Now, since the lease is really financing a piece of property, plant, or equipment for a specific time frame, and you happen to have use of that property during that time frame, or you are using property during that time frame, the government lessee has control. Again, the financing language is common, and we need to be careful to what to look for in that language. In many cases, contracts that are currently reported as leases really are financed purchases. And in the call I had right before this session, we were talking about computers from a particular manufacturer, and they said, gee, at the end of the lease term, the computer company gives us the option to buy those leases for a dollar payment. Is that a financed transaction? And I said, yeah, if you intend to keep it and keep those computers, it certainly is a financed transaction, a financed purchase. So you got to think about that as you analyze each one of these contracts. The only time that you would record just an outflow of resources like the old operating leases would be a contract that has a maximum possible term under the contract of 12 months or less, including any options to renew or extend, regardless of their probability to be exercised. Now, this language, as I told you the last session, there is an exposure draft that's out there from the GASB, clarifying the language on the probability and the term measurement, as well as the short-term leasing measurement, especially in the case where you predicted short-term and it turns out to be long-term, or you predicted long-term and it turns out to be short-term. That all is about to be clarified. Comments are due on September 17th, and it may be approved for implementation next year. But you need to know that that is coming out shortly, and certainly read it on the GASB's website. Now, let's calculate a lease term. Dog ear, bookmark, print, circle this page, as you're going to be seeing it over and over and over again as you implement GASB 87 and, oh, by the way, GASB 96 and GASB 94. In each contract, there needs to be identified what is the non-cancelable period, and that's the period where neither party can cancel the contract. And we need to ask ourselves about 4 potential options after that. Does the lessee have an option to extend the lease? If yes, then add that period to the non-cancelable period if it is reasonably certain that the lessee will extend. Does the lessee have an option to terminate the lease? But is it reasonably certain that the lessee will not exercise this option? If yes, then add those periods as well. If your government is a lessor, does your government as a lessor then have the option to extend the lease? And it is reasonably certain that your government will require an extension. If yes, then add those periods. And then finally, does your government as a lessor have an option to terminate the lease? But is it reasonably certain you would choose not to? And again, adjust those periods on there. Now, sum all those periods up, and that is your lease term. And again, for lessors, mirror image. And again, a mirror image of lessees. And that, but the constant throughout there is this reasonable certainty clause, and that's in both the lessee and lessor calculations. That is important, and that should be part of your policies and procedures that should be developed by your government. Who determines reasonable certainty, and when is that determined? That should be part of your policies. Again, GASB does not have a strict definition of reasonably certain. However, in the basis for conclusions of GASB 87, there's a sentence indicating that reasonably certain is more than probable. Now, if you talk to your legal counsel, some of us say the word probable means 75% certain. So we're talking more than 75% certain. Now, if there are periods for which both parties have the option to terminate without the permission of the other party, or if both parties must extend, then those are cancelable periods. Governments will need to reassess the lease contract if the original prediction is an extension or a termination, and the extension or termination does not occur, or vice versa. After all, the time factor needs to adjust, as well as potentially the interest factor, depending on the length of the extension. Okay, so that is our reset. James, let's talk a little bit about subleases.
All right, thanks so much, Eric. Great to be here today, and glad I'm able to give you a break and doing all the talking. So subleases up next. So subleases and subletting have been part of accounting literature since basically the original standards that Eric talked about earlier. What's the difference between a sublease and a sublet? A sublease is usually dealing with something that's already leased, and a sublet is usually leasing only a portion of that leased asset to another party, such as a room or just a square footage of the area that you're already leasing. So do a quick internet search and you'll find millions of sublets and subleases at your fingertips. Also think back to your own experience. Chances are that you sublet or sublease an apartment as a college student. Over the last 60 months, we've seen a number of sublets and subleases increase significantly due to the COVID-19 pandemic. People moved out of big cities or across states at the beginning of the pandemic. And when they realized how long it would be, they would sublease so they wouldn't have to pay a penalty. This is one of the more popular ways to temporarily relocate. Investment firms are also finding a good rate of return in leasing property from a landlord and then subletting that property. And in some cases, they're even involving some single-family homes to sublease. Governments are also frequently involved in subleases. Eric talked about two during the last webinar. One involved the cell phone tower. A private landlord signed an extremely long-term lease involving land to a county. The county erected a tower and sublet space on the tower to a city and to other entities. That's kind of a classic sublease. Another involved a public university that leased a dorm building from an insurance company. The university then sublet dorm rooms to students. The sublets to students resulted in short-term leases as they were only for the academic year without an option to renew, but they were still considered sublets for that dorm. Might be easiest to talk about, just focus on the subleases. So under GASB 87, the GASB emphasized that there are at least two contracts involved with the sublease. The initial contract involves the original lessor and the original lessee, and then the second contract that involves the original lessee, who is now the lessor and the subleasee. So this can get really messy really quick. So it's kind of helpful to diagram what's going on here. So keep in mind that the original contract must allow for subleasing, or else the original lessee may be violating the terms and conditions of the contract, which could be a cause for termination. I can't imagine if I was one of those students and the university violated the terms and conditions on its contract with the insurance company. I'd be pretty mad if I were out on the street without a dorm room. So lesson in this, terms and conditions allowing sublease are key. So make sure that those are in place in the contract before you start subleasing or accounting for those subleases. Now that we've got the setup of the contracts, you need to remember that the original lessee is still paying the original lessor the lease payments in the contract based on the provisions of that contract. So regardless of whether they're subleasing those dorm rooms or subleasing whatever they're trying to sublease, regardless of their success rate, they still have an obligation to make that payment back to the lessor. The second contract, on the other hand, may have different different provisions such as term, payment amounts, use of the assets, and others. So the lease is completely unrelated to the original agreement. The sublessee will make payments directly to the original lessee without the lessor being any the wiser. So there's a potential for a profit or some kind of realization on those subleases. Now, whether the original lessee pays the original lessor is not really a concern of the sublessees, is not really a concern of the subleases unless there's a default. If there's a default, it's going to be a mess and a house of cards occurs, and there's likely going to be proceedings in court. So now what's changed from old GAAP? Old GAAP prior to 87 involved little to no disclosure of subleasing. It was the wild, wild west of financial reporting for subleases. But think about your college dorm. How could you could have been in one or hundreds of or thousands of dorm rooms, all involving subleases. The lessor only had to disclose the total minimum sublease rentals to be received in the future as of the reporting date, and only for capital leases. For these original lessees, this is one of the pesky transactions that in GAAP that were netted. Now, though, you'll be happy to know GASB 87 does not require the disclosure of payments to be received because the payments to be received from subleases would be included in the lease receivable and the note disclosure of future lease payments required for lessors. Similar disclosure, so there's similar disclosures for lessors. The change in GASB 87 was a result of GASB's view that the lease and the sublease are at least two separate transactions entered with, and this will be key later for lease-leaseback transactions. So in this case, there's different parties, and accordingly, GASB concluded that there's no longer a basis for offsetting the lease payable and receivable amounts. So we'll talk about the lease-leasebacks in a little bit. But that's kind of the key differentiation, is that there's different parties involved for the subleases. Also in old GAAP, subleases were common with sale-leaseback transactions. They're still common, and we'll still talk about those in a few moments. Those transactions are complex even under GASB 87. So now that you know what's supposed to happen with subleases, what is now required? Keep in mind that for subleases, there's at least three parties involved. So there's the original lessor, which could be a government or even a private entity. If the lessor is beyond the reporting entity for financial reporting purposes, your government doesn't care. For operational and legal purposes, of course, the original lessor still matters. Then there's the original lessee. Now, this may be your government, or if your government is the sublessee, then it is which your party is leasing from. If your government is a sublessee, chances are you have no relationship with the original lessor. Then there is the new lessee. Again, this can get really confusing very fast. And this could also be a government or a non-government. The parties theoretically should be unrelated, and we'll talk about related party transactions in a bit. So if you're reporting for your government, the party should be beyond the arm's length of your government in this case, outside of your reporting entity and completely unrelated to one another. That means it's not a separate fund, it's not a separate agency, department, it's not a blended component unit, it's not a discretely component unit of your government. So they should all be completely separate. Next, the original lessee, the second party or the party in the middle of the slide with the boxes on it, becomes also a lessor. So therefore, all GASB 87 provisions for lessors would apply if the second party is a government. So you would apply all any kind of GASB consideration or GASB 87 considerations for that lessor to that government. If the second party is a government, two or more transactions result that do not offset. If your government is in the middle box, it is now the lessee and the lessor. So you'll have two separate disclosures. Now, if the third party is the government, then the third party would apply the GASB-87. If they're not a government, let's say one of our students and we're a public university, the student is likely not preparing a personal financial statement in compliance with GAAP. Due to this new disaggregation, we now need to disaggregate the note disclosure. So GASB-87 requires a disclosure of sublease activity and a separation of lessee and lessor transactions. You can still group transactions that are similar. So for example, back to our public university, disclosure of the individual dorm room transactions would be a little bit onerous and really silly. So likely they would be short-term leases that would not require disclosures beyond the inflows. For other transactions with lessees that are not short-term, definitely group those sublets or subleases that have similar terms and conditions for that. All right, so let's put that theory into action. Sticking with our public university, by the way, this is a real lease, sublease situation. And of course, we're not going to include the names to protect the innocent. So here we have a 20-story dormitory that is brand new. It opened this month right before July 4th, ready for the students and right in time to implement GASB-87. The building is leased from a major insurance company for 30 years, and it's non-cancelable by both parties. The university is not an investor in the insurance company, nor is it an entity within its reporting entity, including the university's foundations. The university occupied the building on day one and made a $600,000 annual payment on July 1st. The dorms were ready for students and had 3 classes of dorms: studios for all our introverts, AKA accounting students, 1 bedrooms, 2 bedrooms, and quads. Given that our counterparties to sublets were not of legal age in our state, parents and guardians signed leases for all under the age of 26 per the university policy. The leases are solely for the academic year. Students may change dorms within each academic year, and the rates change with each year. Parents of college-age children, I'm sure you've been going through this since late spring, with which dorm is the right dorm and making those payments. All right, so now let's get to the numbers. Our first transaction as a lessee will be the lease to the insurance company. Let's call the insurance company EMU Insurance. The discount rate was not stated in the lease, so then the university decided to use its incremental borrowing rate for a similar term of 30 years. The CFO certified and documented that 4.5% is reasonable and is equivalent to its incremental borrowing rate. Our debits and credits would be on the screen. Since we have a 4.5 rate over 30 years with a $600,000 annual payment due at the beginning of the year, the present value is now $9,773,333. We have a debit to a right to use asset, which is student dorms, and a credit to a lease liability to EMU Insurance. So we learned all about that, those entries in the first workshop in June. But then we have lots of other transactions. Since we have 400 dorm rooms, we have a separate transaction for each student in each room. Each is a separate lease document, and all would then be short-term since there are no extensions allowed for these dorm rooms. The Office of Student Accounts would then record a receivable for each student as payment comes due, and that would be from various sources, whether it's the parents, it's from scholarships, it's from grants. And as we learned in workshop 2, the receivable could be potentially offset by uncollectible accounts, but let's hope that the university is going to get all their money. So given we've just short-term leases, the credit would then to be revenue. So upon payment from various sources, we debit cash, credit receivables. Now, if these were actually long-term leases, then you would just account for them using the standards and guidance as a lessor. But just one of the key things to remember is that there is no netting with the lease, with the original lessor. So let's go to our second polling question at this point. So a government leases a 50,000 square foot building from a developer for a non-cancelable 20-year period. Beginning in year 17, the government leases 5,000 square feet to a not-for-profit for the remaining 3 years as the government no longer needs that space daily. The journal entry to record the lease with the nonprofit should be A, debit cash credit revenue, B, debit the receivable credit deferred inflows of resources adjusted for uncollectible amounts, C, debit right to use asset, credit lease liability, or D, debit lease expense and credit cash.
Somebody asked, do we have any Excel templates set up? Yes and no. Certainly we have them for our own internal purposes. We also have a relationship with a software company. Certainly, if you want to reach out to us directly to engage on that we'd be more than happy for that person. Certainly, if you're a current audit client, there are certain limitations we'd have to do with you, but certainly we can help you to the extent possible. Just reach out to James and I after the session. Let's see, is there anything else? I don't. Okay, yeah, I don't see anything as of yet, but let's see how we're doing. James, back to you.
All right, so it looks like 42% of you got the answer right. The answer is B. It's not a short-term lease, it is for 3 years. So our debit is to receivable, credit to deferred inflows of resources, adjusted for uncollectible amounts. Then we're gonna amortize the receivable and deferred inflow based on the effective interest rate upon the cash collection. So we learned this in workshop 2 a few weeks ago. All right, so let's continue on. Sale-leasebacks, lease-leasebacks, because this isn't complicated enough. All right, so your government may be considering a sale-leaseback right now. Why? Due to remote working, some governments may be in a hybrid work environment permanently. They no longer need the space. We're considering that. A lot of public agencies are considering that. So the space may not need to be used anymore. Another reason why there could be a sale-leaseback is that a lease may be more flexible than bonds for major capital improvements to an asset. So let's say, for example, you have a capital asset that needs a $50 million rehab, but your government has no capacity to sell bonds. Further, government may not want to start a large rehab project on its own. The government can sell the building with the provisions that the buyer, who's more likely than not to be a developer, would then lease the building back to the government after the rehab is complete. The developer now has a lot of incentives available to them, including historical rehab or energy efficient credits, depreciation, interest expense for the developer's borrowing, and so much more. The government turns an underused asset at historical cost into cash and then has a right to use asset upon occupancy that they can sublet or sublease at that point as well. So sale-leasebacks are hard to understand unless all the documentation is thoroughly analyzed and the flows are charted. You almost have to draw a picture of the transaction. There are a couple of steps before you can determine if it's actually a sale-leaseback transaction. And similar to subleases, you may have 2 sets of disclosure. So charting these transactions is kind of key when it comes to any of these more complex lease transactions. So the first step, there needs to be a sale. And that's a lot easier said than done. The gap for a sale transaction doesn't change due to GASB-87, but the provisions have been placed since GASB-62, and they really stem from old provisions from the 1950s prior to the GASB and the FASB. All right, so for it to be a sale, all parties to the contract have complied with their provisions in the contract, including all terms and conditions. When this happens, a deed usually transfers and the sale is non-cancelable. Money or assumption of debt has been exchanged, and if financing is needed, financing is arranged. The parties are legally separate, and in the case of governments, they are beyond the reporting entity. There is no continuing involvement with the selling government other than the future lease. And then finally, the buying entity must have investment provisions and subordination. The buying entity may sell the property at its own desire. The next step, after we now know we've got a sale, we have to make the determination if it's a lease. Now, let's go with the assumption that we now have identified this as a lease, and we now have 2 separate transactions likely occurring at different times. especially in a building rehab situation where the lessee government may not have occupancy until a future period. Like all sales, the gross price of the sale is offset by the cost to sell, including legal fees and transfer costs. Under GASB 87, the net proceeds after those fees and costs is then compared to the carrying value of the building. For many governments, the carrying value may be zero due to their age. That's why they need the rehab, right? So if the building has a carrying value of zero, then the net proceeds would be recognized as a deferred inflow of resources as a credit. If there was no leaseback, then it would be recognized as a gain. The debit would then be to cash or a receivable. Now, there may be some situations where the building would be sold at a loss, and in those situations, a deferred outflow of resources would be debited, or a loss or a loss in that case. So the deferred positions are going to be amortized over the term of the new contract, the lease contract, as we no longer have a capital asset to depreciate since it's already been sold. And like most other GASBs, there's an exception to this too, which would be for short-term lease. So in practice, I doubt a government would sign a short-term sale-leaseback, but who knows, there may be one out there. So it's just something to consider. So the next transaction would be the government's lease, and it will be recorded just like any lessee transaction that you learned in the first workshop. Now, there could be quote unquote off-market terms, especially if the government needs to get rid of the building quickly, maybe for cash flow purposes or for other reasons. They may sell the building at a fire sale. Hopefully that's not literal. If there's a difference between the sale price and the fair value of the building, or the present value of the lease payments due to the differing terms is determinable, then the difference may be a borrowing or a debt. But again, only in limited situations would we see this in practice. If your government has a sale-leaseback, follow the guidance for capital asset sales and for leases for disclosures. Now, let's say your government has regulated operations such as airports, ports, or maybe even affordable housing. There may be regulatory accounting and disclosure that you have to consider. But given the complexity of those transactions, give either Eric or I a call or shoot us an email, and we'd love to work with you on it. It's just too in-depth to go into today. So let's go on to our next polling question. So my government no longer needs a building. The building will be sold to a non-related developer. So that related party consideration is eliminated. So the developer gives my government a call before closing saying, I have this other building your city may be interested in. It's in similar condition. I'm willing to lease it to the city at a discounted rate from market. If the lease transaction closes, is it a sale or a leaseback? A, yes, an incentive is there. Yes. B, yes, as the sold building and the lease building are one and the same once closed. C, no, if it did happen, the transaction would be fraudulent per GASB 87. And D, no, GAAP requires the sold building and the lease building, in this case, to be the same building. So what do you guys think?
All right, go ahead and answer that one. We do have one question. It says, is a software company Civix, C-I-V-I-X?
You know, I'd rather not promote the company. I'm not sure I'm allowed to by contract, but it is not Civix. And there are a number of companies that are out there. And, you know, and certainly we can talk to you about the pros and cons if you're trying to make a decision as to whether or not to do a piece of software to do your GASB 87 conversion. But, you know, one thing that certainly I've found in implementing so far, you know, the sweet spot is maybe 20 to 25 leases, maybe 30 leases or less. You could handle it with Excel as long as you have reasonable internal controls. Anything beyond 25 or 30, you really need potentially a piece of software. And you know, with our current clients, we're dealing with maybe 5 or 6 different pieces of software, including the one that we actually have a license for. But certainly reach out to us at any time. We're more than happy to talk to you on it.
All right, so it looks like 41% of you got the question correct. So the answer is, here's D, and it's from GASB Implementation Guide, question 4.72. A sale-leaseback transaction involved the sale and leaseback of the same underlying asset. Because a sale and a lease relate to two different underlying assets, they should be recorded as two separate transactions. The rent concession should be recorded as part of the consideration for the sale rather than as a lease incentive, and therefore should not affect the initial recording of the lease. All right, so let's talk quickly on lease-leasebacks. This is a lot easier than sale-leasebacks. The asset is leased between a government and a lessee, and then the lessee leases the same asset back to the government. Now, this one could be an entire capital asset or just a portion of a capital asset. Due to the nature of the transaction, being leased, leasing the same asset back and forth, the parties are the same, and this isn't the case where you can actually net because the parties are the same. You can net and are considered to have a right of offset, but the transaction still has to be disclosed separately. So we see this in practice in construction. After all, the developer of a project may need control of the land to rebuild the building. Like sale-leasebacks, a private developer may have tax incentives to do a lease-leaseback. Again, these transactions are not as complex, but if you have one, give one of us a call and we'd be happy to work with you on recording those transactions. So Eric, why don't you take it over for related party and intra-entity leases to wrap up on GASB 87.
Well, thank you, James. Go get yourself some water. That'd be great. And thank you for all your help today. So back in our May webinar, we talked about component units as part of GASB 84 and 97. Now let's go back to the future and wind the clock back to May and look at our decision tree that we presented back then. And now consider related organizations. And there must be some form of legal separation. And that's in that top left-hand box up there. We got to be legally separate. And if your government holds the corporate powers, the entity is part of your government. If not, no harm, no foul, then not part of your government. Now we're going to go down the left-hand side here. If your government holds a majority equity interest in an organization that is not for income or profit, then the entity is either a blended or a discretely presented component unit. But let's say that the majority equity interest provisions do not apply, which they don't apply in a lot of situations unless you happen to be a tribal government or maybe a hospital or something like that. And you have a doctor's practice on the, connected to it. Let's say that it doesn't apply. Next, is there an appointment of the voting majority of the board or of the other organization? If yes, then is there a financial benefit or burden? Or, and that word or in that center box down below there, that word or is really important. Is your government able to impose its will? And here's where it really gets tricky. If there is a voting majority appointed, but no financial benefit or burden, nor is there an imposition of will, then we're at some form of a related organization. Now that's important for GASB 87. Otherwise, we're at a blended or discretely presented component unit. So even if you don't have a voting majority, but if there's some form of fiscal dependency, or if you judge that it's misleading to exclude, then you're back at a blended or a discretely presented component unit. Otherwise, a further related entity could be a joint venture, which is in the center red box that's there. And, there are a bunch of entities that are out there that are joint ventures, say water, sewer districts, or, insurance entities like risk pools. Sometimes are joint ventures. Airports sometimes are joint ventures as well. And so you just have to follow the decisions all the way through. Bottom line, there are lots of ways we could be at a related entity lease. Now, due to these relationships, multiple answers occur in accordance with GASB 87. If the lease is between a blended component unit and a primary government, it doesn't matter. If you're a lessee or a lessor, then the transaction is a due to, due from, for the general purpose external financial reporting purposes of your primary government. GASB 87 doesn't apply. So again, if it's just between, say, a building fund and that happens to be a blended component unit, remember, you got to have that legal separation there. It happens to be a blended component unit, comes on as a building fund or something like that, or a public works fund, or you name it, that could be a blended component unit. GASB 87 doesn't apply for the internal transactions. It does apply for the separately issued financial statements of that blended component unit. Now, if the lessor is the component unit, now we're the public works entity or the public facilities entity, then the debt and the assets of the lessor are the primary government's debt of the assets, and the debt service is reported as the primary government's debt service activity. So again, for the entity-wide financial statements, everything sort of collapses except for the standalone financial statements. And that's a big except for here in that left-hand box. Unless the blended component unit issues its own standalone financial statements, then GASB 87 would apply if they issue their own separate financial statements. If they don't issue their own separate financial statements, GASB 87 collapses onto itself, and all we have are due tos, due froms. Okay, now let's say if the lease is between two blended component units where there are eliminating entries. And we know that ever since GASB 34 was implemented, and then it was updated by GASB 35 and 61 and a bunch of other GASBs ever since then, including 61 and 80 and 90 now. Okay, so if we have a lease in between two blended component units where there are eliminating entries, then the eliminations are done prior to reporting to the primary government. And the due to, due from between the component units, those are all eliminated. And then all cash transfers are just that, transfers. So let's say you have the building department or the building component unit, and it leases to another blended component unit. All those transactions are eliminated before it gets to the city government or the county government or so on, unless those entities do their own separate standalone financial statements audited separately. In those cases, you leave GASB 87 on, but as part of the combining process with the county or the city, all those transactions get eliminated. Finally, and this is where it's a little bit more sane, if there are leases between a discretely presented component unit and the primary government, or between discretely presented component units, then GASB 87 does apply. Further, there are other receivables and payables that are usually involved between component units and primary governments. Don't combine those receivables and payables with the leasing. So think about this if you happen to be in this situation, which is really common. Now, this is where the party really gets fun, and we're going to break out the streamers and so on. If you have a related party lease, these are really common. Now, related parties are not only the related organizations on our spaghetti tree a few slides back, or joint ventures, but they're also potentially defined in your charter, your bylaws, your constitution, your state law, your ordinances, you name it. There is likely a definition of a related party in reporting of related party transactions in accordance with law. We usually see this in transactions with board members, senior management, or their immediate families. And again, You know it when you have it because you probably have state or local reporting of related party transactions. Now, these lease transactions are subject to GASB 87, unless there are some backroom off-market smoke-filled room leases, meaning the lease discount rate is far less than market. Again, these are usually defined in statute, and the term of the lease could be structured favoring one party or another. And the government may have a short-term lease in exchange for a higher payment. Now, disclosure would be required primarily in accordance with state law, and otherwise, you're going to end up disclosing the terms and conditions of the lease, but don't name the related parties. Don't put somebody's name in it. I've seen too many financial reports of firms across the country that are not our firms, that sometimes you see people's names in it. That's not proper into an annual financial report. Don't put the name in it. You've already disclosed it to your state or local government in accordance with the law or regulation. And again, remember our spaghetti chart. If the primary government has an equity interest in the related party, then you have further disclosure needed in accordance with the equity method of accounting. Now, I bet you're saying, Eric, how often does this happen? Well, more than you think. And in this lease that is redacted, the county is a lessor and it's leased property to a state highway patrol. Clearly, the names are redacted here to protect the innocent. It does happen. I don't see a lot of these so far in our implementations, but it does happen. And one thing that you may see in the auditing, which is not fully finished as of yet for GASB 87, is doing a search for related party transactions, as we're doing right now as part of our audit engagements. So with that, on to our next polling question. So let's say, the cell tower site is between a county and the state highway patrol. What do you think on this one? You think it's subject to GASB 87? The parties are unrelated, not subject to GASB 87, as it's a blended component unit in the primary government, maybe subject to GASB 87, but the transactions get eliminated prior to aggregation, or maybe subject to GASB 87 as the highway patrol is a discretely presented component unit. And if you need to go back and take a look at it, but it's so highly redacted, you might as well just look at the facts here.
While they're answering, Eric, do you know how to determine if a charter school is a CU of Authority School District?
Good question. I think that's a really good question. Charter schools have always been the minefield that's out there. It's, in some cases they are, in some cases they're not. I mean, we do a ton of charter schools, especially out west, and in some cases, yeah, the governing board of the local government is pretty much the same as the charter school. In other cases, they are not. They may be totally unrelated. I know where I'm currently sitting in Boston, Massachusetts, the charter schools are completely separate. They're subject to state oversight if they do happen to be failing. But beyond that, they're completely separate from the school district. So it really depends on facts and circumstances. If you'd like, one of James's partners in the in our California offices deals a lot with charter schools, and she'd be more than happy to talk to you on it. But that's a great question. There was another question that I saw. If the lease is between one department of the primary government and another department of the primary government, would this be excluded and treated as a due to, due from? And it's great to hear from this questioner, one of my favorite folks in the world. Absolutely. I think it would still be a due to, due from, unless those departments publish separately issued financial statements. And so that would be the only exception, but you'd have essentially two different transactions going on there. Amy, how did we come up with our polling? All right, so the subject to A, 36%, absolutely, you are correct. We're just waiting to see if you're correct. Yeah, usually a state highway patrol and a county, they're going to be legally separate, so they are unrelated. Okay, guess what, folks? You made it. You made it through, hey, 5 hours of webinar time on GASB 87. And that was that's a long, strange trip. I'm a Grateful Dead fan, so I have to say, long, strange trip it has been. Okay, so there are 2 other GASB standards which use the leasing model. I mentioned these at the top of the session. GASB statement numbers 94 and 96, public-private and public-public partnerships and availability payment arrangements and subscription-based information technology arrangements, respectively. Okay, so GASB 94, or in other words, P3s, there's also this little pesky thing in there called availability payment arrangements. And what's all this stuff about? So first things first, the implementation date for these 2 standards is going to be for fiscal years beginning after June 15 of 22. So you have about 300 and some odd days to go. Which is 1 year later than the original exposure draft way back when. But just so you know, we got about 300 some odd days to go. GASB was already considering to extend these standards by a year due to COVID, and they made the change to the P3 standard first about a year ago. And again, by the way, when we talk about GASB 96 in a few minutes, it's going to be the same implementation date as 94. Now, the P3 standard, it modernizes the service concession arrangements gap, which was issued back in 2010, well before the current leasing provisions in GASB 62, and certainly before GASB 87 that we talked about for the last 2.5 webinars. And much of the SCA guidance doesn't really change all that dramatically, but some of the payable or receivable measurement might change. And understanding the jargon is kind of like any other GASB standard. Once the definitions are known, the accounting and then the financial reporting falls into place. And looking at the definitions for those who didn't fall asleep, throughout our sessions, these may look familiar from the outset. So first, the P3, that's an arrangement in which a government, the transferor, contracts with an operator, which is, in most cases that I've run into in practice so far, a non-governmental entity to provide public services by conveying control of the right to operate or use a non-financial asset, which is usually infrastructure or some other capital asset, which are known as a P3 asset for a period of time in an exchange or an exchange-like transaction. Now, where have I heard that before? You heard about it at the top of this hour, at that top of the last hour. Now, a public-public partnership is the same as a P3, but with another government. And where do I see that? I see public-public partnerships a lot in, say, tollway authorities, which are governments, that are component units of states. I see it a lot in state data centers and so on, which are legally separate. So you see that in really in a lot of cases. And then we have these new things, these availability payment arrangements, and those are arrangements in which a government compensates an operator for services. And these are usually for like design, build, operate transactions. And it's for a non-financial asset for a period of time in an exchange or an exchange-like transaction. But these payments are variable and they can't be measured with any form of certainty. And this could result in just a transfer of an asset or just an outflow of resources. Now, at the bottom there, that's on our service concession arrangements. And again, the language really hasn't changed since GASB 60. And I've run into a bunch of these in practice. Municipal golf courses is one we'll talk about, I think, in a little bit. Now, GASB 94 ties to GASB 87's framework in a particular circumstance, but it also ties to GASB 91 conduit debt obligations, which is beyond the scope of today. But we're going to bring GASB 91 back before the end of this year, because that's going to have to be implemented as well. So, join us for later on in the year if you're really interested in GASB 91. If the debt is conduit debt in accordance with GASB 91 and the issuer of the debt retains the title to the asset and the payments from the third party covers the debt service in accordance with the debt service schedule, well, the arrangement, then you have to say to yourself, does the arrangement meet the definition of a service concession arrangement? And if the answer is yes, then it's reported under 94. If it's not a service concession arrangement, and we can go back to the previous slide, just go real quick back to the circle that bottom there, and that's your definition of a service concession arrangement. But again, hasn't changed in about 11 years. Okay, but if it is not a service concession arrangement, it might not be a lease, even though it may be titled a lease. But for the ultimate third-party obligor, it is a debt. And again, that's a conduit debt transaction. So the key is there, does it meet the definition of a service concession arrangement? And it's common to be confused by all this jargon. The easiest way from the confusion is to go through some examples. And I put this in alphabetical order. And let's talk about that new one, an availability payment arrangement. And in this case, a corporation designs, builds, finances, and operates a mass transit system. The corporation runs the system entirely for years in accordance with the contract, and all fares are remitted to the government. But the government turns around and remits fixed payments back to the corporation based on certain milestones, and that's an APA. Now we have two types of P3s. One type is with a private entity and the other is a public entity, and both are operating a toll road. They may or may not meet the definition of a service concession arrangement we talked about over the past few minutes, and the counterparties earn revenue from the tolls collected, and the government receives payments from the counterparties. Now, finally, this is a common one, and I had one of these as an audit client in Southern California, adjacent part of a well-known stadium authority, which you may watch once a year. Let's just leave it at that. Here we have a golf course and a pool owned by a city government and operated by a private entity. And in the case of my client, during football games, spectators could park cars at the golf course and the pool parking facilities. Further, city residents had discounted rates at both the and the budget is approved by the city council. Now that is a classic service concession arrangement, and it's likely a P3 per GASB 94. Now these examples of P3 of P3s are common as infrastructure needs and are growing, and governments are realizing that having a municipal golf course is not really what it used to be. They're more than just highways. And think about this list now, and think about the operating environment we're in today, and I underscore the word today. Now, that aside, okay, think about what the Senate approved a couple of nights ago, at least to go forward and debate on the infrastructure bill pending in Congress. You're going to see a lot of these coming out of the infrastructure bill because it is a major thrust of the federal government is to do public-private partnerships. You're already seeing this as part of cybersecurity. It was announced earlier this week that the White House signed a bunch of public-private partnership transactions with cybersecurity companies to invigorate the cyber security network in the country. So just stay tuned. You're going to see a lot of these coming up in practice. And P3s are more than just highways. The rebuild of LaGuardia Airport is a blueprint for the future. That was a P3 between the airlines and the Port Authority of New York and New Jersey. And the Port Authority of New York and New Jersey is the largest component unit in the United States by far. And they have a bunch of these public-private partnerships. The Long Beach Civic Center, my guess, it hasn't hosted anything but COVID triage in months. And although the convention center business is starting to pick up again, we had a big convention of cardiologists here in Boston over the past couple of days. The broadband network in Kentucky and the water sewer program is probably doing pretty well, irrespective of COVID. However, these are really long-term plays for the counterparty involved, and it's usually typically an investment bank. Parking garages, office buildings, dorms, they could all be places where a government has assets that can be monetized using other governments or some form of corporate flexibility. For example, the dorm room questions that James was talking about before, typically colleges and universities do public-private partnerships. And the fact pattern with an investment company, remember EMU Insurance, that is a real public-private partnership, in fact. So, and so again, these could be all over the place. The variations of definitions and contracts may result in different outcomes. The result is a bit of a decision tree. First, you got to take a look if your government has a P3. And if the government has a P3 that meets the definition of a lease, but not that all-important service concession arrangement, then we're back at GASB 87. So that's why we're talking to you today on this one. Because again, you could fail back to GASB 87 if you have a P3, but not a service concession arrangement where your government has no control over the operator. Okay, so what about the other decisions? Now, if the government that is involved with a P3 transfers an existing asset to the operator, well, then GASB-94 applies. You have a receivable declared and a deferred inflow of resources, just like GASB-87 for lessors, and almost the exact same calculations. Now, if the P3 involves either a new or an improved asset, but meets the definition of an SCA that is purchased or constructed by the operator, then the asset that is purchased or constructed is recognized by the original transferring government, not the operator, and there is a receivable for the installment payments and a deferred inflow of resources, just like a lessor receivable. But what if we have a new asset acquired or purchased, but it does not meet the definition of an SCA? Well, the asset acquired or purchased is only recognized at acquisition value at the future date of the transfer, which again could be 40 years from now at the end of the P3. And again, we have just a receivable and a deferred inflow of resources, just like a lessor. Once we break it down into a tree like that, it's a little bit easier to swallow all this stuff. Again, you saw this similar to before. The calculation of the receivable at the transfer of government is the same as lessors with the same elements. There may be incentives, upfront payments, and so on that impact the receivable amount. Now, given these contracts tend to be lengthy, the discount rate setting process is key in this calculation. And the next piece would be, do you have any sort of collectability issues? I mean, when I was a state controller, we actually had an operator of a P3 fail. They went bankrupt, and they were dealing with a road that they were not allowed to put tolls on the road, but they had the ability to lease the property along the side of the road. Well, they couldn't lease the property on the side of the road at market rent, and the P3 actually failed. And so you got to think about that. Do you have any sort of collectability issues? For the government, that is a transferor. And the term of the P3 should look a little familiar. In each contract, we got to identify the non-cancelable period, and that's the period where neither party can cancel the contract. And hey, gee, I heard that one at least once before. And then we need to ask ourselves all about those options. And those are on the screen here. Again, do we have an option to extend from the operator? Does the operator have an option to terminate? Does your government as a transfer or have the option to extend? And does your government as a transfer or have the option to terminate the P3? And again, we have the pesky reasonable certainty that's out there. Now you sum all those periods up and that's your P3 term. Now, for those of you who were awake in our first hour and maybe saw the lessee and the lessor webinars, it's the same calculation, ladies and gentlemen. It is. It's the same calculation that a lessor uses in a lease. And you indeed should have deja vu all over again, as Yogi Berra used to say. After all, the transferor is doing the same thing as a lessor. Temporary use of a non-financial asset in exchange for compensation. In P3s, though, it would make economic sense to do it just wouldn't make economic sense, to do a short-term P3, as most of the underlying assets are really long-lived non-financial assets. So if you have a short-term P3 out there, I really want to see it. Because I wouldn't know why an investment house would want to sign a deal with you. Either that or you're paying really extraordinary interest rates. So the key is really calculating what that term is. Now, for transferors, again, you're the government with the non-financial asset. For transferors, the debits and credits are a modified version of that we saw in the last webinar for lessors. The difference between lessors and P3s is whether or not we got that service concession arrangement. And if a new asset or an existing asset is the underlying asset. So again, bookmark, dog ear, circle this page if you possibly can. But going through the debits and credits, the assets and deferred inflows of resources are almost exactly the same as that for lessors. Now, let's say your government is an operator. You're the toll road authority working on behalf of the state highway department. Your government is a totally separate data center, operating on behalf of a lot of governments in your state. So you are the operator. You're the stadium. Again, a decision tree emerges. Now, there are plenty of situations where a separate government is an operator. After all, again, a state turnpike authority may operate a toll road on behalf of the State Department of Transportation. The transaction is a P3, but in this case, a public-private partnership. It's also likely a service concession arrangement. Another non-infrastructure P3 could be a state data center, but not the software. And James and I are going to talk about that in a little bit. The operator would report just like a lessee. Liability for the installment payments and a right to use asset. Now, if an SCA is involved, an additional liability would be present for an asset purchased or constructed or improved. Now, the debits and credits are going to be almost exactly the same as those of leases, but again, there is the aspect of assets purchased or constructed or improved and whether or not we have an SCA. Again, there could be additional liabilities involving the transfer of the asset in the future. The core remaining items of GASB-87 carry into the P3 standard, and we'll see in a few minutes GASB-96. There is a wrinkle in the P3 standard as it also includes, again, this guidance for availability payment arrangements. Again, APAs are arrangements in which a government compensates an operator for services including design, construct, finance, maintaining, operating some form of non-financial asset for a period of time in an exchange or an exchange-like transaction. Now, the transaction could result in an ultimate transfer of an asset or just an outflow of resources. Now, there may be components involved in an APA, which may be payables, and the resulting asset may be a finance purchase. Now, APAs are not as prevalent as large infrastructure projects. They just don't want to be, dependent on funds availability. Yeah, especially if you're dealing with an investment bank, they want a little bit of certainty, or an insurance entity. They want a little bit of certainty for all of those investors that are out there. So APAs in practice might not see too many of these. There are 4 examples in GASB 94, three of which are P3s, which are updated from the old GASB 60. And the 4th is a APA. If your government is party to one of these, switch the facts and circumstances. Obviously, if it's not a tunnel, it's a bridge or a building, switch the facts and circumstances. You may want to take a look. One of the graphics that I really, really love, this was put together by GASB staff, and you really want to, again, dog-ear bookmark it. It's not authoritative, but again, it was prepared by GASB staff for a decision paper for the board, because the board had a hard time going through a lot of this. And if the board had a lot of hard time going through this, I'm sure hundreds of you are having a little bit of a hard time going through all of this as well. So bookmark this page. It's not authoritative, but it helps you through the decision tree. Again, take a look at your situation as you implement the leases standard, and also take a look if your underlying asset may meet the definition of a P3, and just go down the decision tree and see where you lie. If you're going down the decision tree and you land up more to the right side, look at the bottom right-hand box. You land up back at GASB 87. And that's why this discussion over the last 15, 20 minutes is really, really important. You could land up going back to square one. So if the transaction meets both the lease and P3 standards, but does not meet the definition of a service concession arrangement, meaning your city council can't set the budget, there's no control, you don't control anybody using the property, and so on, and the underlying assets are existing assets of the transfer or your government, and improvements are not required to be made by whoever's operating the golf course, they don't have to do it, then guess what, folks? You're back at GASB 87. And so keep this one handy as you implement. So that leads us up to our next polling question. Actually, no, I forgot about the implementation dates. I apologize. There is a polling question coming up. So for those of you who are falling asleep, heads up, we got another polling question coming. So to implement GASB 94, whatever you need and whatever you used on GASB 87, that's going to work on 94. Many of the policies and procedures may work, except for the discount rate setting process, because obviously these transactions last a very long period of time. They're not 3-year leases on cars. They're not 5-year leases on copiers. These last a really long time. So you may need to revisit the discount rates that are set by your government. Leases also tend to be more common than P3s, even if you include things like golf courses, swimming pools, arts, tourism, economic development, recreation facilities. All those tend to be service concession arrangements. So that said, from an audit perspective, these transactions are difficult to understand and implement. If you have a P3, call us. And just let us know. Again, these transactions are super hard to understand without looking at that previous slide here. I'll go back one more slide here. If you didn't have that, it's really hard to follow through. So with that, let's get to our next polling question. This one, a state agrees with a corporation to operate a just open, brand new existing bridge that requires no improvements by the corporation. The DOT remits to the corporation 10 million at the day of signing and cover future costs of collecting tolls. The corporation will remit 80% of all future tolls for 40 years with a minimum monthly payment of $100,000. The DOT calculates the present value of the minimum payments to be about 40 million bucks. So what do we think? Is it a P3 following 94? Public-public? Is it a public-private partnership following 94? Is it an APA following 94? Or a lease? What do we think? We have a diversity of opinion. This one actually is a availability payment arrangement following GASB-94. Yeah, this is the last one, the last example in GASB-94. And the reason why is it's a pure variable payment. Yeah, you got a minimum monthly amount of $100,000 that's there. But if you take a look, this is probably a pretty substantial P3 because the first 10 million covered all of our administrative costs. Now, could you say that there are different transactions? Yeah, with that minimum monthly payment. But at the very least, because of the 80% of all future tolls, rather than the 20% there, it is an APA. And so an availability payment arrangement. So this one's a little hard to understand, but it is the fourth example in GASB-94. Okay, so James, how about bringing us home and talk about GASB-96 or SBITAs?
All right, thanks, Eric. So I know it's beginning to sound like an infomercial, but wait, there's more. But this is really the last piece for the GASB-87 lease accounting standards that's related to it. So, well, until GASB changes its mind, anyways. GASB-96, SBITA's subscription-based information technology arrangements over the past. So a lot of entities over the past year, due to the pandemic, have begun to explore and have even implemented some IT solutions that require the use of virtual systems and hardware such as servers, since many were working from a remote location. So this will just get more prevalent as time goes by. So this is probably one of the more timely GASBs out there. So SBITAs are more prevalent in practice than P3s, and for some governments, even more prevalent than regular leases. You're probably using at least one right now. Well, we are with Zoom, but then there's Office 365, Adobe, Windows, antivirus or firewall software, Mimecast, NetSuite, Salesforce, and just a whole suite of others that's still out there. So they're software. They're all software as a service, or SaaS, SaaS. Windows Azure is a platform as a service, or PaaS, and so are Apple iOS and Google. IBM and Oracle offer infrastructure as a service, or IaaS, along with Cisco, Citrix, and other providers. So the largest data warehouse as a service is, of course, Amazon or AWS, and another is called Snowflake. So differentiating them is kind of tricky, but simply put, SaaS, software that's available via third party over the internet. PaaS, it's hardware and software tools that are available over the internet. And then IaaS, cloud-based services, pay-as-you-go for services such as storage, network, virtualization. And then we have this DWAS, or data warehouse as a service, provides data storage and data warehousing management services without investing in any kind of proprietary data warehouse solution. So these are all colloquially known as cloud computing. So GAAP really needed to evolve in this area because the trends, most notably as proven by COVID, these tools are becoming more and more essential and have become essential very, very quickly. Second, the cost, data integrity, and data management risk of providing these services on premises is skyrocketing with various cyber attacks, and as well as the maintenance of the hardware. The costs are definitely going up and up and up. Next, the speed of evolution of these tools, including artificial intelligence. We have robotic process automation that's coming, and other bots that continuously update to defend against intrusion. So it's been actually pretty incredible to watch all this stuff come up. So most, if not all, governments can't keep up with all this these tools coming online. Finally, the structure of these contracts are like P3s, which we just heard about, but far less flexible. So further, they're subject to local jurisdiction laws, such as in Europe, where we have the General Data Protection Regulation, and then in California, where we've got the California Consumer Privacy Act of 2020, which goes somewhat beyond the European standards. So if you deal in data and haven't understood these standards, you may want to catch up on them, but that's really beyond the scope of today's presentation. There are lots of really, there's a lot of those in really tiny print screens that we all swear we read in 10 seconds, and we scroll up and just click the box, and they're dozens of pages long if printed, and that button that we click or hit with our fingers, it says, I agree to the end user license agreement. That I know we all read in thorough detail before we click that box. So for governments, there's a lot of diversity in practice right now. Like leases prior to GASB 87, many of these agreements were just contracts recorded as a payable and outflow when the expense was incurred. But again, as COVID has proven, beyond your personnel, data is your most precious resource. In GAAP, it's an asset, something that has present service capacity that the government presently controls. After all, software, data, and other services drive government operations, and it's under the control of the government, even though a license is agreed to. So you may be using any one of these, including right now. Right now, you're using Zoom and likely Office 365. You may be watching this on Windows Azure, Apple iOS, or Android. Your government storage may be on AWS or Snowflake. Your government's technology infrastructure uses some form of Citrix, Cisco, Oracle, or IBM. And maybe you use Mimecast to scan your emails for viruses. You may be using Salesforce for citizen engagement or subrecipient monitoring, which of course we can do. We can also help you with. And for your financial report, you may be using something like Workivia. All of these may be SBITAs. All of these are contracts that may be structured just like a lease, and that's why the GASB needed to update the GAAP related to these contracts. There are even components to these contracts just like leases. Many of these have ongoing maintenance payments, and you may know these as upgrade payments or upgrades. There may be transition or conversion costs. There may be customization costs. Undoubtedly, there are user acceptance testing, data conversion support, labor, training, and a whole other suite of aspects that can apply to your contract. So in many ways, these arrangements could be just like a lease, but with some important differences. So GASB 96 has some, hopefully at this point, some familiar language to you as of now. So after all, it's appeared many other times during our workshop. A subscription-based information technology arrangement is a contract that conveys control of the right to use hardware, software, or even a combination of both, including IT infrastructure, as specified in contract for a fixed period of time, which is key in exchange or exchange-like transaction. So it's just about verbatim to the language in GASB 87. One thing to consider, though, is when do we apply GASB 96 and when do we apply GASB 51, which dealt with intangible assets? These arrangements have the key difference is these arrangements have a defined time period or end date. If you plan on paying the technology indefinitely, or if you have internally developed the software, then you'll apply the GASB the provisions from GASB 51. So these apply to a fixed period of time. Due to how complex these services can be and the length of time, ERP systems can take to implement. Some of these systems can take many years to actually implement. The existing model contained in GASB-51 on internally generated intangible assets was applied in GASB-96. So according to GASB Statement 51, they're intangible assets if, one, they lack physical substance. Okay, that makes perfect sense. They have a non-financial nature, so they're not classified as an investment vehicle. So they have a initial useful life extending beyond a single reporting period. After all, your email lives forever, they say. So the complexity drives the 3 stages. So preliminary project stage, which includes the conceptual formation and evaluation of alternatives, the determination of the existence of needed technology, the final selection of alternatives for the development of the software. All of these preliminary activities are expensed as they're incurred. So you don't want to capitalize these costs until you've made that final decision. Application development stage. This includes the design of the chosen path, including software configuration, software interfaces, coding, installation to hardware, testing. This includes the parallel processing phase. This is all capitalized within that right to use asset. And then finally, you've got the post-implementation and operation stage. So this includes application training and software maintenance. All of this is expensed as incurred. So the most controversial aspect of GASB-96 is training. And that's what it was when it became GASB-51. So many users believed that training needed to be ongoing as the software keeps evolving. So why not capitalize training? The GASB has existing gap that notes, although the skills obtained by the employers through training may facilitate the development of the computer software, the training itself does not further the development of the software. So it's just how to use the software, how to use your asset. We don't capitalize the cost of, operating a tractor that we're leasing. So it's kind of the same kind of concept. So as long as the training doesn't otherwise contribute to putting the software in condition for use, then it's going to be expensed as it's incurred. So the gap in 96 is nearly identical to GASB-87 and 94. However, there are no provisions in 96 where government is a software vendor. So it's all the lessee accounting. Unlike leases, there's no gap for symmetrical components such as lessor accounting when a government is a vendor and leasing providing these subscriptions to other governments or other agencies. The other difference is that there's no residual value or purchase options to consider when calculating the value. You wouldn't really buy a piece of software when your agreement is done to keep it online unless you want to have ongoing maintenance costs related to it. So one could imagine something like subleasing. It's almost like subleasing provisions in GASB-87 in the future. So the accounting and financial reporting are very similar to lease accounting and lessee accounting and reporting. There's the same debits, the same credits, same principal, discount rate, and term provisions, the same provisions on modifications, terminations, on and on and on. So it pretty much mirrors that type of accounting. The related training costs for the arrangement should be a component, otherwise the intangible asset may be different than the initial liability. GASB-96 also replicates the short-term guidance in GASB-87. In practice, this is going to be interesting. So like in leases, a short-term arrangement is an arrangement that at the commencement of the subscription term has a maximum possible term under the contract of 12 months or less, including any options to extend, regardless of their probability of being exercised. Most of these arrangements in practice are going to be at least a year to 5 years old, because why would you implement a software that's going to be less than 1 year? So once these softwares are implemented, it's hard to change over. So for example, once Office 365's ecosystem is implemented, it's very difficult to change to a different ecosystem. Changing within 1 year without an option to extend would be extremely rare and really not feasible due to the cost of the change. Implementation is going to be the same as GASB-94, just a year later than GASB-97. again, use the facts and circumstances at transition, and it requires a beginning balance adjustment. So you're going to take a look at the date of implementation. So here's a real contract. Obviously, the names have been redacted again to protect the innocent. So notice the licensee is not even named as a licensee. They are named as a quote unquote subscriber. In this case, there's no term. It's a perpetual license with a 5-day cancellation period and an annual fee payment. Yes, this is an arrangement, but since those a subscription-based arrangement, but since there's no term, there's no way really to calculate a liability. So GASB-96 allows these types of contractual payments to remain as outflows or expenses, as there's no way to calculate a present value on them. So the GASB modeled the standard for these arrangements after 87, since they're all essentially type of lease. So we apply all, I've mentioned this before, get all of the GASB 87 provisions. So you're not really learning anything new, just how to apply the GASB 87 provisions. If the underlying asset is tangible, such as hardware, then you're clearly going to follow GASB 87. So you could have situations where you are going to be applying GASB 87 to the tangible assets and GASB 96 to the intangible within one contract. So there could be a combination of the two. The debits and credits are pretty much the same as those for the lessees. Remember, there isn't any gap for any, as the government is a vendor quite yet, but that could be coming down the pipe in the future. All right, so now to get you through all these standards, just remember the framework of GASB 87 is key. I think Eric mentioned this, it's just a gift that keeps on giving. It's complex. It reads, like I said, like an infomercial. There's more, there's more, there's more. Hopefully the GASB won't make any more changes to it. Just update it periodically, but make a plan that is more than just converting to the lease standards. So one thing that you're going to want to do is gather all the contracts that even have a remote chance of being in scope in any or all of these standards, understanding the difference between all these standards. The next step you're going to want to do is you're going to calculate the lease or subscription term. The calculations are almost exactly the same between all the standards, except for P3s. The terms are likely much longer. So for the arrangements, the terms might be perpetual. The subscription term is considered when the asset is placed into service. Then you're going to calculate the liability. So just a note, but it's an important one. If you have multiple modules within the scope of GASB 96, including the original arrangement that are being implemented at different times, you're still going to recognize the full asset when the first module is put into production or put into play. You're not going to go back and remeasure or even put in a new asset for each module. So that's because the vendor has essentially provided control of the asset, even if the module hasn't been set up. And the vendor is going to be charging the government pretty much for the full amount. So once you have the liability, you can calculate the lease or subscription asset. And remember, for the subscription-based arrangements, you may have a second asset that may be intangible for implementation costs. The implementation costs are only those that are incurred during the second phase I noted above, or the initial implementation phase. All other costs, including training, are expenses incurred. So that's just a key reminder. In all, you've got components, combinations, modifications, termination clauses, as well as note disclosures. All these considerations are going to match up with GASB 87. So to wrap this all up, we have a cheat sheet of all the effective dates. For GASB 94, it's the same as GASB 96. So make a note of that. And then we're going to go to our final polling question. So after the three-eyed Bailey workshops on GASB 87, 94, 96, do you feel ready to implement at least GASB 87? Do you feel ready to implement all the standards, but you don't think the GASB 94 is going to impact your government much? Ready to implement all three standards, or ready to retire?
And thank you, James. We've got a question in the question box, and by all means, type a question in the Q&As if you do have a question. For the GASB 96 implementation date, what would our implementation date if we are on a calendar year reporting? Well, it's for periods beginning after June 15 of 22. So if you're on a calendar year reporting, you're going to start as of January 1, 23. But in many cases, the implementation of GASB 96 may be as difficult as 87. It really depends on your type of government and the type of arrangements you may have. Other questions you may have, folks? Let's see if there are any. Well, I mean, the one thing that I've, that I've found in practice, and I don't know, James, so far, but we are seeing a lot of Statement 96 potentials that are out there. Again, I was on a call earlier this morning with a university system, and so far in their surveys of individual departments that they've received back, they found at least a few dozen of these so far in Statement 96. I mean, how do have you seen a lot in practice as of yet, James, or are people just trying to get through GASB 87 first?
Pretty much GASB 87 first. So.
Yeah, absolutely. One of the questions that's coming in the chat box, just scrolled up because a lot of folks are typing up. For text subscription arrangements, is there a materiality threshold? There's a materiality threshold for everything, but remember, as James will tell you as an audit partner, materiality is really an audit construct. You have to work with your external auditor, and you can't judge materiality until you have until you understand if you happen to have a complete population of what you're trying to judge. I mean, James, do you have any differing thoughts on that?
No, you pretty much echoed what I would say as well.
Yeah.
On that.
All right, so there's one here. It says, for educational software for student use purchased on an annual basis, would we need to determine the likelihood of future use, or would GASB 96 not be applicable? Oh, that's a good one. It really depends on who's actually clicking through and licensing. It would have, and I know it's kind of bad form to answer a question with a question, but it really would depend on if you happen to be essentially a pass-through entity as a university or school system, but the real licensee is the student. If you happen to be a pass-through entity, it's almost like a sublet situation, but there's no gap for being a quote-unquote vendor. And you really have to judge on there who's the ultimate user on that. And I think we're going to find that a lot, especially with school districts with Blackboard and things like that. And I hope GASB puts out an implementation guide question on that, because that's a good one. Here's another one. Under Statement 96, is it correct to say if your subscription arrangement has no defined term, will it be treated no different than current? What if the original agreement has a defined term, but the intention is perpetual use? Well, let's go through the low-hanging fruit on that one. If it doesn't have any defined term, if the non-cancelable term is not in the document, I mean, look at your document really carefully. If there's no defined term, you can't do the division. You really can't, and so or the multiplication. I know math is not my strong suit. You can't do the multiplication and the present value of it. So if it's a perpetual license, then 96 doesn't work, but it may be part of 51. But if the original agreement has a defined term, but the intention is for perpetual use, that's where you have to take into account reasonable certainty. And as James mentioned, if you're using Office 365, it's real hard to change to iOS. or real hard to change to Android if you're on Office 365, or excuse me, Google Chrome or something like that. It's very difficult to do that, and so you have to gauge that reasonable certainty. Yeah, there was a clarification put in on K through 12 ordering and paying and not passing through. Well, if K through 12 is ordering and paying, I think, James, we got to potentially look at that contract, again, with like Blackboard or something like that. That could be in scope. The question is whether or not there is a defined term. I mean, wouldn't you think that that would probably be in scope, James?
Yeah, I would definitely think that. It sounds like that the K through 12 would be licensing or subscribing to that software, and just depending if there's a defined term or not, and then just kind of allowing their students to use that software, right? So that definitely sounds like it would be in scope. So.
Yeah, I think so. And I think, again, just watch, you'll probably see an implementation guide question coming up on that in 2022 or something like that. And simply because, obviously there's a lot of school districts that are out there that are going to have contracts with entities like Blackboard and so on. Let's see. If we have a contract with a vendor for software implementation, but we customize the software application to such a degree that the original software is no longer the same, will this software contractor fall under GASB 96 or 51? That's a good one. It's probably both. And you're going to probably land up with the same, answer. You're going to have an intangible asset for the piece of software. The question is, do you got a liability? And if you got a defined term in that software, that's a non-cancelable period, or you have options within that, then indeed you might have a liability as well as an asset. And so you got to be real careful. That asset side, you don't want to count it twice. But remember, the asset side in 96, it's almost exactly the same as 51. So you might as well just apply GASB 96. Okay, anything else? Well, hearing none. Okay, I really want to thank everybody for joining us. We've had hundreds and hundreds of you over these last few workshops. And I really thank James Ramsey for joining me today from Sacramento. And I know you're heading up to lunch and on the West Coast. I want to give you back a few minutes on your hour. With that, James, any final thoughts?
No, thanks everybody for joining us. And if you have any questions or want to work through some issues, definitely email either Eric or I, and we can definitely point you in the right direction.